Put an end to what you're doing immediately. If your children do not remain silent for 20 minutes, you will have to ground them. I am keeping an eye on John A. Just let everyone know that at home or in the office. Do not be bothered. Turn on pilot mode. You will always regret losing out on what I am about to tell you if you allow yourself to be sidetracked in the following 20 minutes. Can you hear me? Very well. Excuse me, everyone, this is an Asian guy. It was Thursday, January 15th, when something truly remarkable occurred. Something that has not happened in 30 years. Global central banks have surpassed U.S. Treasury debt in holdings of gold for the first time since the mid-1990s. Permit me to reiterate that. More gold than U.S. currency, U.S. bonds, and U.S. debt is held by central banks. At this point, the Rubicon has been crossed. At this same moment, the U.S. dollar formally lost its monopoly as the world's reserve currency. This is the point where the world made its decision, saying, "We do not trust you anymore." So, if you are confused about what this means and what it implies, you are in for a costly education. Quiet down. The silver market is set to experience an explosion on a scale that the majority of people find inconceivable. Allow me to explain what happened and why. The gold narrative is where I will begin. Reason being, this is where all other things are built upon. Since the Bretton Woods system fell in 1971, the United States dollar has served as the world's reserve currency for the past half-century. No nation on earth does not have dollar reserves or U.S. Treasury bonds on hand. They own U.S. debt. Why? Because oil cannot be purchased without bucks. In order to engage in international trade, they require dollars. The system is structured such that they require currency. However, an issue does exist. Additional dollars are being printed by the U.S. government. The balance continues to rise. The worth of $1 is steadily declining as the deficit widens. Therefore, other nations have been on edge for a long time. They have been observing the U.S. government's reckless spending habits. They have learned to anticipate the Federal Reserve's bailout of banks via the printing of trillions of dollars. From 10 trillion to 20 trillion to 30 trillion to more than $36 trillion, they have been witnessing the debt spiral upwards. How much longer will this continue? They have been wondering, what occurs, even more crucially, when it halts? That is why they have been gradually branching out into new areas of expertise in recent years. Gold has been their purchase. People from China have been purchasing gold. Russia has purchased gold. Country after country has been purchasing gold, including Poland, Turkey, India, and Saudi Arabia. And for the first time in 30 years, the combined value of gold held in reserve by central banks surpasses that of U.S. Treasury debt. A major change has occurred. There is now clear disapproval of the U.S. dollar. And gold is real, therefore the world is telling you, we do not trust your paper anymore. We want something real. You can't print gold. It is impossible to inflate gold. With its neutrality, gold, no government has any say over it. Sanctions and seizures do not apply to it. That is precisely why it is appealing at the moment, since the U.S. government has turned the currency into a weapon. In response to the outbreak of war in Ukraine, they froze Russia's currency reserves. If China moves on Taiwan, they would retaliate by doing the same to them. In their foreign policy maneuvers, they employ the dollar. The rest of the globe witnesses this and is filled with fear. They reason that since the U.S. can demonetize Russian currency, they should be able to demonetize ours as well. This means that they are leaving. Treasury bills are on the market. The beginning of the end for dollar domination can be seen in their purchase of gold. You could be asking, John, that's fascinating, but how is it related to silver? Absolutely everything. What do you suppose individual investors will do if central banks start to dump the USD in favor of gold? When it comes to companies, what are your predictions? Do you have any ideas on what the well-off will do? After the lead of the central banks, they will follow. They will purchase both gold and silver, the latter of which is considered a younger sibling to the former. For those without much financial means, silver can be considered a form of gold. In times of financial crisis, silver moves 10 times quicker than gold. As you watch this video, we are now experiencing a monetary crisis. Those that have this figured out are going silver crazy. This leads us to yesterday's events, which took place on Thursday, January 15th. The silver price reached $92 Aussie. $92. This is an increase from $30 6 months ago. You just made a 200% move. A lot of money can be made with that maneuver. Overnight, though, something did occur. The price plummeted while the Western markets remained closed. Within hours, it dropped from $92 to $87. Overnight, the illiquid market dropped $5. People noticed red in their brokerage accounts this morning when they woke up. A 5% decline sent them reeling and they freaked out. So they were like, oh no, the rally is over. I should sell. But that wasn't the case. That crash that happened overnight wasn't a fix. Profit-taking did not occur. The banks were acting in a survivalist manner. Permit me to wax poetic. Long on silver, short on other major financial institutions like JP Morgan Chase, Bank of America, Citigroup, and HSBC. For a long time, they were short on silver. They have sold worthless paper contracts without the underlying metal. Furthermore, they are currently incurring substantial losses due to the increasing price. The figures are mine to present to you. Market participants are missing almost 4.4 billion ounces of silver, according per the most recent statistics. 4.40 billion. They have a total short position of that amount across all contracts, exchanges, and derivatives. What is the worth of that short position at $90 per ounce? Add $90 to 4.4 billion ounces, and you get $396 billion. $396 billion. If the banks were forced to sell their holdings at $90, the amount they would owe would be that much. Allow me to paint a picture of the bigger picture. Bank of America is worth around $250 billion according to market capitalization. About $120 billion is the group. The short positions losses would surpass the market worth of several of these institutions if silver remains at $90 or climbs up to $100. They couldn't pay their bills. They would fail financially. Government assistance would be necessary. Even the banks are aware of this. Whatever happened next? Panic ensued. Overnight, they slashed the price. During the illicit trading sessions in Asia and Europe, they poured a mountain of paper contracts into the market. Stop losses were set off by them. Leverage traders were subject to forced margin calls. By sowing panic and terror, they were able to buy themselves some time. Now the important part. The issue remained unresolved. Since nothing has changed at the fundamental level, they simply postponed it. The scarcity of physical resources persists. The demand from industries is still skyrocketing. Nothing has changed in the vaults. Plus, the cost will eventually rise again. The banks have already shown their hand. So when it does, when it goes over $95 and approaches $100, they will be in even deeper danger. Just like that, they demonstrated their desperation, and when banks are desperate, they act similarly. Allow me to present evidence that the physical shortfall is indeed a reality. Reason being, the physical market had a highly intriguing development as the paper price fell from 92 to 87. The rent prices skyrocketed. The term lease rates is best explained by me. Borrowing real silver, using metal for industrial purposes, or covering a short position all incur fees. The leasing rate describes that cost. Imagine it as a rate of interest on borrowed metal. The leasing rate is quite low in a typical market, about 0.5 to 1% annually. The metal can be borrowed and plentiful due to the abundance of silver. The lease rates, however, are currently skyrocketing. 5-10% and 15% are what they're planning. In some areas, the reported leasing rate can reach 20%. Why? Due to the lack of accessible metal for borrowing. The vaults have no contents. The silver itself has vanished. Whoever needs it is in a state of extreme desperation. For a short period of time, they are prepared to spend 15% to 20% in order to acquire metal. One term for this is backwardation. In this case, the difference between the spot and future prices is greater. People want the metal right this second, not in 6 months. A major warning sign is backwardation. There is a shortage and the market is shouting about it. The physical market was shouting the exact opposite as the banks crashed the paper price from 92 to 87 to make it look like the boom had ended. The leasing prices were essentially stating, "We cannot find metal, we need it desperately, and we will pay whatever it takes." This is where the agreement broke down. The paper pricing is obviously false because of this. Because of this, the rally has not concluded. This is only the beginning. What transpired in Shanghai? Allow me to explain it to you now. The endgame has arrived, according to Shanghai. The Shanghai Futures Exchange introduced new position restrictions yesterday, Thursday, January 15th, from 7,000 lots to 3,000 lots. It is the new maximum position size for silver contracts, a 57% decrease that is, in effect as of the 9th session held on January 19th. What made them act in this way? For what reason would an exchange overnight have the position limit? Just because they are about to run out of actual metal to ship. The number of delivery requests is increasing. They are worried they won't have enough money to pay their bills as they see the vaults empty. Dealers are thus being compelled to deliver. Currently, the maximum bet size is being reduced. Physical delivery is something they're aiming to lessen. A gentle force is being applied here. We are unable to manage the current volume according to the exchange. Before the entire system fails, we must reduce the speed. You must not be paying attention if you do not find that noteworthy, considering Shanghai is the world's largest physical silver exchange. Here is where the actual cost is determined, and if Shanghai is experiencing metal shortages, it's a sign that markets around the world are also experiencing metal shortages. Presenting the final act, the paper market will no longer be taken seriously, and the physical market will be in charge from now on. As soon as that occurs, the price will skyrocket. Let me now deal with the most pressing issue. An online urban legend began to spread yesterday. Anxieties ensued when rumors spread that esteemed precious metals investor Rick Rule had liquidated his entire silver holdings. Should I sell too? If Rick Rule is selling, they wondered. I'll tell you the truth. Reason being, the rumor and the truth couldn't be more different. The silver that Rick Rule owned was not all sold. In terms of physical silver, he cashed out 80%. Let me highlight the most important detail though. For financial gain, he sold it. He is currently riding the 20% equity in his home while recouping his initial investment and paying his capital gains taxes. Concurrently, he increased his holdings in silver mining stocks. Then he increased his holdings in silver explorers and producers. Why? For the simple reason that mining stocks are leveraged. The miners might see a 300% or 500% increase if silver prices rise from $90 to $150. As for silver, Rick Rule is bullish. His strategy shifts to greater leverage plays as he reduces position risk. A prudent investor would do this. They pocket the money when they make a tidy profit. They secure their profits and reinvest the funds in possibilities with higher potential rewards. So, you were duped if you freaked out when you heard that Rick Rule sold his silver. There are a lot more nuances to the reality. In fact, even profit-taking investor Rick Rule remains quite positive on silver. He has recently shifted his focus from physical laborers to miners. No, that's bullish. Such risk management is astute. I have the most outlandish prediction I have heard recently, and I will tell you about it now. The latest gold price prediction from Vank, a prominent asset management business, is really staggering. A model known as the Jim Sinclair model is being utilized by them. It was named after the renowned gold investor Jim Sinclair, who accurately foresaw the gold bull market in the 1970s. A very basic model. Simplified, it's the M2 total money supply divided by the reserve gold holdings. If the money supply were to be backed by gold, the consequence would be its fair value. Jim Sinclair anticipated that the price of gold would reach $50,000 Oz in 2007 when he revised the model. Gold prices hovered around $700 over the period. His reasoning was reasonable, but everyone else believed he was crazy. If the government keeps printing money, if the deficit keeps growing, if the debt keeps exploding, eventually they will have to devalue the currency, and when they do, they will revalue gold to back the system. And sure enough, gold jumped from $700 to $1,900 in the following years. The trend was right, though it fell short of $50,000. By 2026, Van has incorporated the most recent data into the algorithm, and the revised prediction is that gold would cost $184,000 Oz, $184,000 to be exact. That needs to sink in, so allow me to repeat it again. The correct price per ounce is $184,000, not $4,000 or $10,000. What gives way to that possibility? The U.S. money supply has grown to nearly $21 trillion due to the explosion of the money supply. The United States government currently owns about $260 million worth of gold. About $80,000 is the price per ounce when you divide 21 trillion by 260 million. Yet the United States is not the only target for Vank. The money supply around the world is what they're examining. The figure increases even further when taking into consideration the entire planet. $184,000. Now, I'm not predicting that gold will reach $184,000 in the next month. I am not claiming that it will occur in 2026. The math is there though, as I said before. There is the model. And if the whole financial system were to crumble, the dollar would no longer be a reserve currency, and central banks would be forced to back their currencies with gold. Then $184,000 is not completely out of line. On the contrary, it is conservative. Where does silver go if gold reaches $184,000? Typically, the ratio of gold to silver has hovered around 15 to 1. That works out to 15 ounces of silver for every ounce of gold. Using that ratio, an ounce of silver would cost $12,267 when the price of gold is $184,000, expensive at $12,000. The ratio will not get that tight, in my opinion. This percentage has been significantly greater in recent decades. Silver would be $184,000 per ounce, and gold $3.67 per ounce, even if the ratio remained at 60 to 1, as it did not long ago. $3,000, that's 33 times more than the going rate. There is no aggressiveness on my part when I say that $300 or $500 is the aim for silver. Being cautious is my style. According to the Vanke model, the potential benefit might be substantially more. Please allow me to paint the broader picture so that you can understand what's going on. The dollar is losing value as central banks are flocking to gold. Financial institutions risk losing $396 billion due to a shortage of 4.4 billion ounces of silver. Due to metal shortage, Shanghai is reducing position limitations. Due to a lack of physical silver, lease rates have spiked. In an effort to gain more power, Rick Rule is shifting his focus from physical assets to miners. Silver might be in the thousands according to Vank's $184,000 gold prediction. You can interpret all of these numbers as saying the same thing. The machinery is malfunctioning, a financial system is crumbling, and the only sure thing are precious metals like gold and silver. Then tell me, to hold silver requires physical possession of the metal. Just because the price went down from 92 to 87 doesn't mean you should sell. You shouldn't sell just because you heard something rumors about Rick Rule. You shouldn't sell just because a CNBC analyst says the rally has ended. Since the endgame has arrived and the price is going to levels most people can't even fathom, you have decided to hold on. The fundamentals are screaming at you. Paper silver, exchange-traded funds, ETFs, and futures contracts all carry the risk of having their value settled at $87 when the market crashes and the force majeure is announced, even though the physical market is trading at $200. Is it something you're willing to risk? Do not wait until next week or when the price drops down to $70 to get silver if you do not already own some. Now that the window is about to close, rates are skyrocketing, mints are experiencing weeks-long backlogs, and dealers are running low on stock. Metal may become unavailable at any prices if you procrastinate. For those who believe the recent drop to $87 marks the beginning of a larger correction, I have some words to say. Whoever believes that silver will return to $75 or $70 is mistaken. That's incorrect. And I'll tell you why right now. Fundamentals did not drive the decline to 87. Manipulation was the driving force. In an effort to avoid going bankrupt, the banks slashed prices in the illiquid overnight market. However, the fundamental issue remained unresolved. The lack of physical resources persists. The need for industrial goods persists. Nothing has changed in the vaults. Shanghai has not yet released its position restrictions. Leasing rates continue to skyrocket. Aside from the price of paper, nothing has changed. It is possible to control the price of paper, however, the material world cannot. Thus, the cost will eventually rise again. The situation will improve. When it occurs, you can forget about the $92 you saved. Then it will start to rise toward $100. When that happens, financial institutions will freak out because their losses become unmanageable at $100. With $100, they require assistance from the government. The system malfunctions at $100. Plus, we will succeed. We will get there. It may not be today or next week, but we will. Hold on to your silver. You'll be glad you did when we do. John, I am asked all the time when this is going to take place, so I'll explain the schedule now. At what point will silver reach $100? When will the arrival of the Martians be? I am unsure of the precise date. Not a single person does. Still, I can assure you that our friendship is strong. You can't miss the signs. Losses for banks totaling 396 billion won, Shanghai reduces position limits, leasing rates skyrocket, and central banks purchase gold. Signals for the endgame are all of these. In my humble opinion, we have weeks, not months. However, this is merely conjecture on my part. We may have a few months, but certainly not years. System fragility is an issue. Way too much pressure. When something finally gives way, the price will skyrocket. You should not wait for anything less than the optimal moment to buy. That moment has come, considering that it will be past the point of no return when more people notice. The metal is going to disappear. The cost will be $200, and you'll be mad at yourself for wasting that opportunity. One last thing before I leave you. Knowing what's coming, the banks are currently acting desperately, smashing the price to $87. Their ability to maintain their position will soon be exhausted. The paper market will be supplanted by the physical market, which they are aware of. They are frightened because they know the squeeze is on the way. You should not fold when your opponent is scared and making a desperate move. When the time comes, hold on. At that moment, you should exert your advantage. At that point, you should stare them down and declare, I am not selling. Refrain from letting them win you over with a $5 dip. Do not be frightened by rumors or false news. Overnight falls in liquid markets are manipulation tactics. You should not fall for them. Preserve your treasured silver. Have faith in the basics and be patient. The paper market will eventually collapse and the physical price will take control. Purchases of gold by the central bank rather than dollars are evidence of this. The position constraints in Shanghai are evidence of this. It is proven by the spikes in leasing rates. The bank's $396 billion loss is proof of that. The evidence is all pointing in the same direction. The machinery is malfunctioning. Silver is skyrocketing now that the endgame has arrived. Keep your composure, calm down, sell not, is about to happen, so brace yourselves. Currency Archives John A.G. here. January 16th, 2026 is the date. The first time central banks have favored gold over dollars in 30 years is very recently. Upon reaching 100, banks will suffer losses amounting to $396 billion. Shanghai is reducing the number of job openings. Rents are going up sharply. In search of greater power, Rick Rule is turning to miners. Gold, according to Vanex's prediction, will be priced at $184,000. The break below $87 is deceiving. This is the last tremor before the explosion, caused by the banks trembling the tree. Keep your wits about you. Preserve your treasured silver. The aim is to reach $300, $500, or perhaps higher. There will be a force majeure soon. The last act has arrived. Subscribing, like, and sharing are important. Remain steadfast. Resist the urge to give them your